All right, we've got 20 minutes to go before the closing bell rings. And while investors are getting their last trades in before the holiday weekend, we got a fresh look at the labor market today that we want to show you. U.S. jobless claims fell unexpectedly last week to an 11-week low. This is a good thing when it falls. 202,000 Americans joined the unemployment rolls versus an estimate of 212,000. We did see what are called continuing claims. This is the total number of people getting unemployment checks. That did jump to 1.841 million versus the 1.839 million expected. But the big number comes tomorrow. 8:30 a.m. Eastern, the Labor Department releases the March jobs report. Economists are expecting 60,000 non-farm payrolls to be added to the economy. The unemployment rate, well, expectations are that it'll hold steady at 4.4%. But is weaker hiring and growing uncertainty from the Iran war clouding the outlook for the labor market? And what about high oil prices that we've seen? Joining me now on a Fox Business exclusive, Federal Reserve Bank of New York President and CEO John Williams. Great to have you here in studio. Thank you for coming.
Great to be here.
The oil shock. Let's just get to that right away. How concerned are you about that playing into and raising inflation? We haven't gotten the March inflation report, and we're expecting the February one as well. We just got February for January, so it's a little bit delayed here for CPI.
Yeah, obviously, higher energy prices affect inflation. It affects also the disposable income that families have, too. So it hits both inflation, but also it hits demand in the economy. And so for us, with a dual mandate of maximum employment and price stability, something I am watching very carefully. How is this playing out in terms of prices? How large are the effects on prices? How long do they last? But also seeing what's the real side of the economy in terms of growth and jobs.
You're watching it, but so far, the war started February 28th. To what degree do you think the war has affected inflation?
Well, it's showing up in gasoline prices, clearly. I think anyone who's filled up the tank has seen that. It isn't showing up in the official statistics, as you mentioned, yet. It will as time goes on, because those are a little bit lagging. But so we'll have to collect that data. We don't have a lot of the official data, but we're definitely seeing it in terms of consumer energy prices, gasoline prices.
You gave a speech on Staten Island to an economic group on Tuesday. And you said that you think the uncertainties, the risks to achieving the Federal Reserve's goal of getting inflation down to 2% have increased. I mean, to what degree? Do you think that there's any need for a change in the overnight Fed funds interest rate?
So I think the uncertainty and the risks have increased, but they've kind of increased in both directions, both higher risks of higher inflation, but also greater risks of economic slowdown. And so, again, we want to balance those risks. I think monetary policy, with the actions we took last year and where we are today, is actually well positioned to keep those risks in balance, and that's what we need to do. We can't control everything in terms of, gas prices are changing, but what we can do is try to get monetary policy positioned so that those risks to achieving our two goals are in balance. So right now, I think they're in balance, but we'll have to watch that data as it comes in and see how the risks evolve over coming months.
Well, here's the thing about oil. Oil isn't just something that goes into gasoline and goes into people's gas tanks. It goes into their leggings, not your leggings, but a lot of people's leggings. It goes into asphalt, the tires on cars. It goes into packaging of what people eat for lunch. Do you expect that that is going to work its way through? And how long of a vapor trail will it have, even if oil starts to moderate once again?
Right. That's absolutely right. There's a pass-through of energy prices into a lot of things that we buy, including airfares. We're just talking about that. With higher fuel costs, airfares are going to go up. So it will spread around. It typically takes into other goods and services. That typically takes months or maybe a year to have that full effect. But we put that into our analysis, think through what those effects are. But you really hit, I think, an important point. What matters a lot here is how much do energy prices go up and how long do they stay elevated. Right now, the markets, when they price what they expect in oil prices, they're pretty optimistic that oil prices are going to be coming down quite a bit over the next year. But of course, we'll have to see what actually happens.
How do you avoid overreacting or becoming too late in making a decision to move on rates, whether it is a cut or a hike?
So, I mean, this is the problem we always face. We have to be forward-looking. We have to be looking where the economy is likely to be in the next year or two, because monetary policy actions, they don't take the full effect on the economy for at least a year.
Now, there's that lag effect.
The lagged effects, going back to Milton Friedman's famous quote about that. But we have to always be forward-looking, but we also have to take into account all the data and what it's telling us, and managing those risks. So I always say, we have to take into account the totality of the data, the economic outlook, but also the balancing those risks. So it's really trying to balance, not don't want to overreact, but at the same time react in a way that keeps inflation expectations well anchored and keeps us on a good path getting back to 2% inflation and doing our best to maintain maximum employment.
What would worry you about tomorrow's Labor Department report for the month of March? The expectation is for a build of 60,000 non-farm payroll jobs to the economy.
Well, I mean, I think the expectation is more of the same of what we've seen over the past 6 months. We've seen, modest job growth, but consistent with a pretty level unemployment rate.
What about layoffs?
Well, layoffs has been the thing that hasn't really been happening on large scale. As you pointed out just a moment ago, layoffs have been relatively low. So that's, again, I think a sign of a low fire, and relatively low unemployment economy. So I guess my expectation is we'll see more of the same, and that's actually consistent with my forecast, at least for now. But of course, we haven't seen the effects of the uncertainty in energy prices yet in terms of jobs. I mean, that's too soon to see that in the data.
Inflation, 2% is the Fed's target rate. There are people, Wilbur Ross, who I just talked to about that, he does not think that that is the number target that we should be aiming for, that is an old number, goes back in history to the New Zealand model, thinks it's outdated. Do you?
No, I think I think 2% balances our various objectives. We want price stability. If there was a question in your mind, do Americans dislike high inflation? We know the answer. Unequivocally, high inflation is damaging, corrosive to our economy and the well-being of Americans. So we will want to keep it low. If you try to push inflation too low, then you get into issues about monetary policy being constrained at zero interest rates and other factors. So you want to get this Goldilocks somewhere in between. It's not because of New Zealand in 1989. We think hard about this. We do a lot of analysis. So do other central banks. It's a good balance. And importantly, it has served us very well. A lot of people, as we went through the high inflation after the pandemic, and we saw the inflation last year with tariffs, people have, based on surveys, based on market expectations, have been, I think, confident that we will bring inflation back to a low level. And of course, I'm absolutely committed to doing that. So I think it's the right number, but it's absolutely important that we actually achieve the low inflation.
Okay, stay right there. The pain will continue because John's going to come back with us in just a minute. I'm going to ask about private credit. Blue Owl hitting another all-time low today. What worries the New York Fed about all of these private credit redemptions? And could it become a systemic risk to the economy? Much more with New York Fed President John Williams straight ahead. Stay with us.